told you repeatedly that in this earnings season, beaten down stocks in the right sectors have been able to rally even off of what some people consider to be not so hot numbers. Take the industrials. We've seen some great quarters from General Electric, Boeing, and even, I would argue, 3M. But the industrials with suboptimal numbers, they've been bouncing too. Consider what happened today with Eaton, ETN, the big manufacturer of electrical control products, power management systems, hydraulics, truck transmissions, and aerospace components. Now, this morning, Eaton reported a 3-cent earnings miss off of a $1 basis with lower than expected revenues that declined by 9% year over year, thanks in part to that strong dollar hurting the company's overseas business. Making matters worse, Eaton cut its full-year guidance for the second quarter in a row, citing continued industry-wide weakness. And what happens? The stock rallies $1.60, almost 3%. Some of that is because Eaton stock is so beaten down that it's sporting an accidentally high yield, 4%. In short, the stock price was already baking in a lot of weakness. Plus, there were some actual positives here. Not only is Eaton expanding its restructuring program in order to cut costs, but the company also announced that they've got $1 billion in capital they're ready to deploy next year, and they said their top priority will be buying back stock and maybe do some acquisitions. With Eaton trading at nearly 12 times next year's earnings estimates, that was enough to cause a nice rally. Can it keep climbing? Let's check in with Sandy Cutler, the longtime chairman and CEO of Eaton, who's retiring next May. Find out more about the quarter and his company's prospects. Mr. Cutler, welcome back to Mad Money.
Thanks, Jim. Good to be with you this evening.
Okay, Sandy, I saw some positives. I think that the cash flow, surprisingly, despite some of those things we just talked about, is holding up pretty well, actually better than expected. And obviously, you have a nice cash balance that you can do a lot of different things with. How would you think that you can deploy the capital to make it so your stronger markets can have more money in them and maybe some of the weaker markets cut back?
Sure, and Jim, you're right. We had all-time record cash flow in the quarter of $973 million. We've said that next year we expect our cash flow to be up 10 to 15% from this year. We're doing very well in terms of converting on what we've told investors about in terms of having a stronger cash flow company. We were very clear with investors at the end of the second quarter that we expect to split future cash flow about half between M&A and buying back shares. Currently, at the current week's share price, we've been focusing a little bit more on buying back shares. The quarter, as you mentioned, we came in at 97 cents. That was halfway in between our guidance, the 95 and the dollar. I don't think any real surprises for investors there, but as you correctly noted, we made the decision to enlarge our restructuring program because we've seen organic growth in our individual markets decelerate as the year's gone on. So we think the responsible thing to be doing is get out ahead of this as much as we can, cut costs in the company, and be able to drive earnings growth next year in spite of a weaker top line.
All right, now, which do you think of the markets, electrical products, electrical systems, hydraulics, aerospace, vehicle, which of these do you think have the best 2 or 3 year prospects? For instance, I think aerospace, which you already had great 3% organic growth. If there was a way to do an acquisition in that space so that it would turn your mix a little more, it would be great. But are there just not a lot of good things for sale in that sector?
No, we continue, Jim, to be bullish on the opportunities both in aerospace and electrical. Both those businesses we think will grow again next year. Those are the 2 areas we've been telling investors that we're anxious to continue to grow in. So if we can see the right opportunities priced correctly, we wouldn't hesitate to add to that. At the same time, we're also aware that we have investors who are interested in seeing us buy back shares. That's why we said we think this rough balance of 50-50, but during periods of weakness, we'll be opportunistic in buying back shares.
All right, Sandy, we on the network spend a huge amount of time debating not if the Fed should raise, but when, because there's a perception among many people who come on that it's really the right time. When I look at your mix and I hear about your end markets, I question whether you would think it's the right time to raise interest rates.
Yeah, we do believe that, look, we've been almost 8 years at these abnormally low interest rates and very generous monetary policy. At some point, we've got to get back to more realistic activity in that regard. So I think most of our peers would agree that this first step in 25 basis points or whatever it turns out to be is really priced into the market at this point. And it's time that we start to get to a more normal monetary policy and then address the real elephant in the room, which is to start to deal with responsible fiscal policy.
Some of your markets, I know, have gotten a little bit better. I mean, when I look at Europe, I think that Europe has got a possibility. They're doing a lot of things there to be able to make things better. With your tax regime, does it matter where it's good? In other words, if you don't have to, if you can take it so that because you're Irish domicile, $1 in Europe or a euro in Europe actually works a little bit more to your advantage than it would be if you were located in the United States, correct?
Well, and clearly our tax rate is largely a result of where we earn money, so that if our business is stronger in countries that have lower taxes, and most of Europe is that way, that actually results in a better flow through to our investors. One of the big advantages of our redomicile in Ireland a number of years ago is our ability to move cash around the world. That has broken free additional cash for our shareholders for the larger dividends. We increased 17% a year ago and 12% earlier this year, for our ability to buy back shares, $650 million last year, $450 million so far this year. So that are real benefits to our shareholders, and it also means that we have the cash for, importantly, as you mentioned, for growing the portions of our company where the markets are stronger, and we would like to build on that.
Oh, excellent. Okay, well, Sandy, great to see you. I know that the stock had a really big move today, and the industrials are back in favor. So thank you so much for coming on. Sandy Cutler, Chairman and CEO of Eaton. Good to see you, sir.
Thanks, Jim.
These are beaten down stocks, and if you think that the economy is going to come back, they are certainly the right place to be. Mad Money is back into the money. Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.